Hey everybody, welcome back to another video. Today we're going to be going over something that I'm really excited to talk to you guys about, and that is the repo market. Now, essentially what the repo market is, if you guys aren't aware of it, is essentially the lifeblood or the engine that really drives activity in the financial markets. So this is something that we're going to be wanting to pay close attention to coming into the future here with, a lot of uncertainty and whatnot. In markets with Fed policy, political climates across the world, and it's something and a tool we can use to our advantage to help us make better informed decisions, and like I've talked about in previous videos, giving ourselves the best probability of coming out on top when it comes to making decisions with our money and our investment. So first of all, I wanted to just go over exactly kind of just the basic kind of mechanics between institutions in this kind of world. It's not something that I see getting talked about a lot on the mainstream news and stuff like that, to be quite honest with you. When I was in school for economics and accounting and stuff like that, things like the repo market never really, come into conversation. So essentially the way it works is we have the bank of Rob and we have the bank of the viewer, which is you at home. Now, I have, just say for example, I have a $300,000 worth of accounts receivable that I'm going to be getting in 3 weeks or something like that. However, I have a bit of a problem because I don't have the cash or the liquidity that I need to meet my payroll obligations, for example, 2 weeks from now. Okay, so say for example I need 100 grand. Okay, you, the bank of the viewer at home, you say, hey Rob, we like working with you. We have the 100 grand that you need, to meet your payroll in 2 weeks from now. But we're going to give you that 100 grand. We're going to want 2% interest back on that 100 grand. And in the meantime, we're going to want some collateral that we can hold, just in case that you go bad for some reason on paying us back our money. So I go, okay, sweet. Sounds good. Bank of the viewer. I'll give you 100 grand worth of Teslas, and we'll call that the pristine collateral, or the most desirable form of collateral in this instance. So 3 weeks goes by. I get my 300,000 from my accounts receivable. I take 102,000 of that and I pay you, the bank of the viewer, back, and then you give me my collateral back, which is my Teslas. Okay, simple enough, right? So the reason for taking out these loans can go a lot further than that. Say for example, there's a maybe I see an opportunity in like a forex market or crypto market or any sort of market, and I want to borrow that 100 grand and I want to leverage it up and put on a short-term swing trade, make a ton of money, pay you back your principal and interest, and I pocket the spread on whatever I make from that, and we kind of go from there. Now, it's really important to understand and to be paying attention to this kind of activity in the markets, because it's essentially that it's essentially the thermometer that is going to sound the alarm when there's going to be trouble. Obviously, well, not obviously, but a lot of you might know we live in a credit or debt-based monetary system where all money that is currently in circulation has been borrowed into existence and is owed back to a private bank with interest. So let's just say hypothetically that, I'm not the only financial institution that is looking for this cash or liquidity to meet my debt obligations or my payroll obligations or whatever kind of expenses that I have, right? I have those receivables on my books, but I don't have the actual cash or the liquidity. So now, instead of having just me coming to you, now you have 5, 6, 7, 8 other institutions coming at you. Well, what do you think that's going to do, right? Obviously, there's a huge demand for that cash out there. So you're going to say, well, 2% isn't quite good enough, but hedge fund John says, he's the most desperate and he's willing to pay us 10% interest for that cash that we have on our books. So we're going to lend it to him. And then that's kind of like now the going rate, right? So this has a lot of big impacts in, the real world as well, because, now your mortgage rate is based off of that 10% interest rate or that market rate. Now, instead of it being 2%, now it's 12% because, there's a spread there that the banks have to make as well. So looking out for stuff like that is generally a good sign that, there's going to be some trouble coming down the pipe, and we're going to want to get prepared for that. On the flip side of that, things can go kind of even worse. Now let's just say, for example, that there's lots of cash and stuff like that out in the system now. And we'll go look back at an example of like 2008, for example, when Bear Stearns and Lehman Brothers ended up going bankrupt. A lot of the pristine collateral that we talked about earlier, being the Teslas in this case, was mortgage-backed securities back then. People kind of realized exactly what was going on with those, and it was kind of game of a charades. And, a few of these institutions, that's really all they had on their books to post as collateral. So now you go, well, Rob, we'll give you the 100 grand, but we're going to want, the whatever interest rate that you want on it, but we want, we want diesel pickups instead of Teslas, for example, right? Well, I'm shit out of luck. I don't have any diesel pickups. All I have is, Teslas. And in the instance of Lehman Brothers and Bear Stearns, well, other banks like JP Morgan, stuff like that, maybe they wanted something like US Treasuries or T-bills or something like that. But all that those guys had were, huge amounts of mortgage-backed securities that were ended up going bad and being defaulted on. Other institutions didn't want to hold that collateral because that collateral wasn't safe anymore either. Where the real issue comes in here is when this kind of market between financial institutions freezes up. If that freezes up, that's a big problem for you and I kind of out here in the real world. So you go to the gas station, you try to fill up your tank, and you try to tap your MasterCard. Now all of a sudden that payment isn't going through because that credit market is frozen up. Nothing's moving, right? Banks aren't lending to each other. There's no economic activity. So that's where we're going to get into something here. And what I talked about in a video yesterday was having some, assets and some of your wealth outside of the traditional banking system, whether that be physical cash or gold, silver, Bitcoin, Ethereum. It doesn't matter. You have to have something that's outside of a bank account to kind of ensure that, you can survive in the meantime if, something like that goes down. I'm not going to say that it is or isn't. I'm just saying that it might be a good idea to be prepared. And again, this is not financial advice. This is financial opinion, obviously. So everything I say, take it with a grain of salt. And if you disagree with me on anything, I'd love to hear from you down below. What it is that you look at. That's one thing I like to look at is just the credit markets and how kind of nicely and effectively everything's working on that front. So it's really important to understand that when we went through the 2008 GFC financial crisis, I was still in high school at that point. I think I was in like grade 10 or something like that. Turned 30 this year. So we still have the same kind of debt-based credit system that, these problems will arise again and again. It's not a matter of if, it's just a matter of when. So it's really important to figure out what it is that people are going to be scrambling for. And honestly, people are always going to be scrambling for cash in this instance, right? Because of the amount of debt that people are carrying, the amount of debt corporations are holding, the amount of debt sovereign entities like, Canada, United States, Europe, everybody just up to our eyeballs right now. So you got to have money to pay your interest, right? And in a situation where, things, can go south really quick, like we saw in March 2020, for example, as a result of what happened in, 2019 there with that repo market interest rate spike. Powell came out with that QE, or that not QE that he described as. So it's really important to not have everything that you own invested in assets. Now, don't get me wrong, with inflation and everything like that, holding cash over the long term, 10 years is probably not a good idea. If you lose 5% of your money compounded over the next 10 years, well, you lose like something like 40-50% of your purchasing power. That's a shitload, let's be honest. But at the same time, not if, because we already decided that the probability of, something like 2019, 2020, 2008 happening again is highly likely. Having that optionality, holding that cash, specifically US dollars, is, it's something that can really pay off big dividends for you. And that's something that I learned kind of the hard way, I guess, back in 2020, was just understanding kind of more of the plumbing aspect of things, of financial markets, versus just, oh yeah, just buy stocks and buy this and buy that because, everything only goes up. Like I said before, we want to be making sure that we're selling stocks when people are buying them, and we want to be buying stocks when other people are selling them. That's kind of just my strategy that I follow, and I like to focus on more of kind of narrative-based investing, but that's just me. I'd be interested to hear in the comments what you like doing yourself. But yeah, that's kind of how the repo market works. Why it's important to understand, and most importantly to pay attention to, because it really is the lifeblood that ensures everything either works smoothly or doesn't in the financial world. So if you guys enjoyed this video, be sure to like the video. Really important that we get this kind of information out to more people, so that more people can see this kind of stuff and under things on a more deeper level, to help them make better decisions. And if you kind of like this content that's no BS, just kind of shining some light on some things that not a lot of people talking about, helping us unplug from a lot of those lies that we've learned from our parents of give your money to your financial advisor at your bank, and don't worry about it, just dollar cost average and buy a diversified portfolio of stocks, bonds, and mutual funds, and never worry about it. This is definitely going to be the channel for you. So be sure to subscribe as well, and share this information with as much people as you can. In the meantime, we'll just leave it there, and hope you guys enjoyed the video. Thanks for watching till the end, and we'll see you on the next one.